Chris, thank you very much for joining us today. So much has happened in the last few weeks. The last time we spoke was in late January, and it seems like every week is 10 years now. There's so much happening with in terms of trade wars with Canada, the US, Mexico, and also China. And then there's also the threat of tariffs, and there's just so much happening in the world. So I thought it'd be good if we just spent a few minutes together and get the sense of what you think is happening. I had a great chat yesterday or earlier this week with Professor Steve Henke. He's a economics professor at Johns Hopkins University in Baltimore. And I was asking him how this cycle compares to previous cycles. He's lived through a lot of cycles. He's been teaching for over 50 years. And he said the time period he's witnessed here in the last few weeks or in the last couple of months, he said he's never experienced such turmoil and confusion as he has this time. And he even said there's more confusion going on right now than there was during the 60s and 70s. And there was a lot going on back then. But I want to get your views on the S&P and the NASDAQ. And just to recap for our viewers, the S&P peaked out in February the 19th at 6,144. It's now at 5,700, give or take. It's down 7%. The NASDAQ peaked out a little bit earlier in December at 20,173. It's now down about 11%. Why don't you pull up the S&P chart and we can get a look at it here and get your views on where you think it's going.
Yeah, sure. Well, thanks for having me back on the show. It's always fun to talk markets and economy. Yes, so if we take a look at the SP 500, there's some pretty interesting price action going on in terms of when we look at the daily chart here of the SP 500. As you mentioned, it topped out up here just above 6,000. I think the really critical thing that's taking place here is we broke this January 13th low. And we watch this as followers and I, we watch this on the intraday chart. And we know as soon as we break that, that is a level where a lot of people are going to have their protective stops in place. Meaning if price breaks that, a lot of people are going to have an order set to execute, to dump them out of the markets or stocks. And we saw that it flushed down. We've seen the VIX now spike up to some levels we haven't seen in a very long time. We saw the put call ratio spike up above one, which means people are buying more put options than call options. Meaning people generally, when the put call ratio spikes, it means people have sold their stocks and now they're buying leverage betting on falling prices. They're like, I'm buying serious leverage like a lotto ticket that this market is collapsing and I'm going to profit from it. Typically, when we see that happen, the market goes the opposite way. And so what's happening right now when we look at the SP 500 is we have what looks to be a cycle low. We've run the stops, which is usually what the market does. It wants to get the longs out by breaking a previous low, and everybody spooks. And then as everybody gets ready to in position for a big collapse, the market has a rebound and moves up. And one of the best ways to look at this, I use cycle analysis, and this is a really good way to get a gauge of kind of what's unfolding here. The key to look on this chart. So this is where my whole strategy comes back from 2001, where I got into sound waves and cycles and vibrations. Long story short is we have, let me just grab this tool. We have these red, it's down, have this red, if I can draw on this chart, sorry about that. Here we go. These red circles down here. Now these are clusters of cycles, more or less time cycles where we have multiple cycles in the stock market putting in significant lows, multiple longer term cycles. And when you have a cluster of cycles, it can generate panic selling. It can create a very significant low in the market. And after all of these, we tend to see the market move higher. And really, this last time, the market really struggled to make new highs. We're making one right now. And the market shows that we should have some type of bounce over the next week or two. So based on cycle analysis, the way the markets and everything kind of vibrates and flows, we should be expecting a bounce. So couple that with what I was just telling you, James, is how we just had panic selling. All the people who were long and who would have got out if that stop was hit are now out of the market. They're betting on lower prices. And so now I'm expecting some type of bounce going into more or less March 24th or so, 24th, 25th. We should expect a bounce up. And the big question is it a bounce or is it the start of a new rally? And we're not going to know that until it bounces up. And we have to see what other assets are doing, and how big the money flows are in or out of various assets and things like that. So that's kind of like the view for the SP 500 from
And
kind of
Chris, I
that.
just want to interject.
Yeah.
Where is this in relation to the 200-day line?
The 200-day moving average, let me just pull that up right here. So the 200-day is, you can see we're right on the 200-day
Okay.
as we
Yeah.
speak right here. And I have seen a lot of people talking about the 200-day. And of course, if we zoom back, you can be like, oh, we kind of tagged it over here. We broke through it over here. The 200-day, people get really caught up with, oh, we're touching the 200-day, or the 50-day crossed above or below the 200-day. I mean, it's such an slow, it's a year-old data, right? And people think it's such a critical level. Like in hindsight, you can be like, oh, it's bouncing up that level, but I don't really look at it. The focus of the 200-day is if it is sloping up, and price is above it, we're in a bullish environment. If it's sloping down and price is generally below it, we're in a down of a bearish market. And right now the market is up. It is tagging it. So yeah, it could be a technical bounce. But I don't ever look at it as a buy point because it can fluctuate through this level by several percentage points and shake you out of a trade. And it's not great for timing. It's just great to be like, the overall trend, the long-term trend is still up and it is pulling back towards it. Uh, it might find support, and all the stuff I just told you about, the stops being run, the panic selling, people buying downside protection, the cycles bottoming. That's the stuff that actually tells you really when the market should be putting in a bottom. But yeah, you're right. It is touching the 20-day and, or
Or the
sorry, the
200
200
day.
day.
And
Uh,
then when you said, okay, so you're expecting a bounce,
mhm.
do you think we're going to come up to like 6,000, 6,100, and then fail again?
I think we'll come up to probably 60-10. You know, it could come back up. Maybe it wants to poke to a nominal new high, but overall, I do believe it's going to stall out somewhere here around 6,000 or just above 6,000
And
on
then
the
head
chart.
lower?
And then roll over and head down. Yeah, that's what I think and feel is going to happen. But you know, once price gets up to that level, if money's piling back into the markets and the technicals and the sentiment are bullish again, you know, it could be the start of a new rally. And that's what we have to wait and see. Right now, we've moved to cash on our short-term strategy. We're just waiting to let this market figure out, how long is it going sideways for, and then which direction is it going to pick, up or down, and then we can take action from there.
Why don't we take a look at the NASDAQ? The NASDAQ has been under more pressure, down 11% from its top or from its peak in December.
Yeah, so the Nasdaq definitely is pulling back a lot more. It has pierced a little bit more through the 200-day. Typically, when you get away from the SP 500, everything becomes a little more volatile, I find, meaning support levels can get swung or broken, and trend lines can get broken more. Moving averages can be pierced more. But definitely, when you look at the 200-day on average, I mean, it acts as a support level. It's had very much the same type of price action of the SP 500. We saw it move up here. It ended up breaking the January 13th low. And of course, there's a lot of fear in this market. It's really kind of creating a tidal wave of people selling, and people are moving out of the markets. So it's waiting for all that selling pressure to alleviate before it's going to have that oversold bounce. I think it might be more so a dead cat bounce, as we just saw in the SP 500, a bounce back up somewhere into the middle of all this noise, and that's going to act as resistance. And then from there, it could easily, potentially break down and go a heck
So
of a
just
lot
to
lower.
summarize, in the next couple of days, you're expecting a bit of a bounce off of this 200-day line.
Yeah, more or less until more or less March 25th, we're showing an upward bias in the market. So
Okay.
it looks like it's putting in a bottom today. In fact, if we look at this candle, this is the same for pretty much all the indexes. They flushed down to a significant low today. They're rallying back. And the short-term charts, even the 30-minute charts, are telling us that this should be a flush out, and we should see a short squeeze into the close. A lot of people are short here. There will be a lot of people wanting to probably cover their shorts going into the weekend. And so we're starting to see this market move higher. The SP 500, if we take a look at it real quick, the 30-minute chart here is really cool. When you understand and have the proper tools to navigate this market, this is the 30-minute chart over the last 5 or so days. We've had multiple waves of this red. Whenever red gets up to this blue line that I have on here, that means the market there's FOMO. People think the market's bottomed and they're piling in. And so you can see what happens to the NASDAQ or the SP 500, all the indexes. Once there's FOMO, once the sentiment indicator that we built tells us there's FOMO, usually the market sells off. We had the same over here, a big gap up, it's sold off. We had it over here, it sold off again a few days ago, and it has sold off. And the flip side of that is when we have panic selling, when people are so scared they're getting out, when there's a certain level of panic, we tend to see the market have a bounce. We had that right over here. We had a big gap down and market had a little bit of a bounce. And of course, all day yesterday, or as just before you and I recorded this on March 6th, the market was telling us going into the closing bell that we should see this market have
March the
start
7th.
yeah, March
Just to
March
clarify.
7th. We should start to see this put in a bottom. And it looks like we've got a flush out low here, and we might see a really strong close to the week. It'll be interesting to see if there's a short squeeze into the close on Friday and send this market higher. So yeah, it'll be very interesting to see how all of this unfolds. The chart, the daily chart shows higher pricing, the cycle analysis shows higher pricing, and the 30-minute.
Yeah. And to your point, anything can happen over the weekend, but not even Jay Powell. He was speaking today and he has no idea what's going on. He's just shaking his head. And he said everything is on hold until they get more clarity with the current administration and what they're doing. And just as a reminder for our viewers, the next Fed meeting is coming up on March the 19th. So just because you're looking at the NASDAQ, why don't we look at some of the tech stocks, because these are the high beta names or risk on names, and it's definitely risk off now. But why don't we take a look at Nvidia, for example? It's currently down 25% from its peak.
Yeah, taking a look at the Nvidia chart, it has definitely been volatile. We've got a series of big rallies, lots of noise, and huge pullbacks, and all of this in this broadening formation of increased, price swings, and now we've got lower highs and lower lows. That is usually a sign of exhaustion, and we've kind of felt that. We felt like the AI, or I've felt that it feels like the AI move is slowly coming to an end. Nvidia has lost a lot of its mojo, especially with the deep seek. All that seemed to take the wind right out of the sails. And overall, it's in a downtrend, and it's down 25%. And again, if the markets are going to rally, Nvidia is most likely going to have a bounce and rally. Nvidia might make it back up somewhere to the 130 or maybe 125. It should have a half decent bounce with the market over the next week and a half, 2 weeks. But I think that might be it, right? I think I just could be a bounce, and we start to see a bigger sell-off. And the basket of these, like when you look at the Magnificent Seven as a whole, definitely have that a lot of damage done. It's come down to the 20-day. We could see a rally in overall big techs, but I think we're probably going to see it sell off. And you can see the volume in the Magnificent Seven. I always find this with these unique sector ETFs, these special ETFs that people whip up because they're getting media and they want to get lots of exposure. They come online, and then suddenly when you see all this volume pile into them, it means the trade is almost done. It means if somebody's already created an ETF for something that everybody's been chasing for the last year and a half, and then everybody piles in with big volume, it's like, okay, well, everybody's already into the space. The ETF is just there to make it easier for those who haven't got into it yet, into those individual stocks. And we saw this with the AI ETF bots. We've seen this with all kinds of different stuff. So it's a huge red flag when somebody comes out with these very specific ETFs, and then suddenly they get all the traction. So yeah, I'm not a big fan of the big tech space. If it moves down, it's going to kill the rest of the markets.
And the related company is Palantir. It peaked at 125 bucks. It's now trading around 80. It's down 36% from its top. Well, look at that. Can you believe that? That's like parabolic.
Yeah, that's I'm not a fan of charts that do that. I hate things that gap huge, and I hate
Yeah.
things that go straight up because they usually come straight back down for at least half the move, if not all of it, and you never know when or how. It's they're so dangerous. Um, I'm just not a fan of it. When we zoom in a little bit here on the daily chart, it definitely doesn't look the greatest. If we were to use a Fibonacci extension based on the strength of this sell-off and this tight little pattern, I mean, it really shows total implosion down to like 43. It should fall to 60, this low here, 61, 62, probably put in some type of bounce, but it is showing a huge sell-off. And that'll just kind of mean, this is kind of a done move for sure. It'll be down like another 48, 50%. to the downside, and that'll completely wipe out everybody who's chased it. And I mean, I had a whole bunch of people asking me recently about this one and what is the other one, MicroStrategy. And when everybody's asking me about it, and a lot of people keep asking me about uranium, and I always pull up the charts. I'm like, well, first of all, those are like not ones you really want to hold. I'm like, they're probably moving down and people are under pressure and they don't know what to do. Unfortunately, people don't have exit strategies. When something turns down, rolls over, you got to get out. People really just hold on to it. This is a pretty bearish looking chart pattern, that's for sure.
Well, why don't we take a look at MicroStrategy now? It peaked at $475. It's now at 290. It's down 40% from the peak. And once again, you alluded to this, but a lot of people use this as a proxy for Bitcoin.
Yeah, I mean, I don't know, I don't really follow this. I don't know why people would trade MSTR if you can just go buy Bitcoin or a Bitcoin ETF. I don't know what the benefit is other than to me it just feels like everybody wants to do it because everyone else is doing it. I'm totally missing something here, but I don't really care that much about the stock because I don't trade individual stocks. But if it's a shadows Bitcoin, why don't you just trade Bitcoin? This looks like it is trending down. It's, it's come down to a support level, this major hiccup here. It's had a bounce. Has a tight little bull flag. Maybe it wants to push a little bit higher. If the stock market bounces, we will probably see Bitcoin bounce, which means this should push up a little bit higher. But it is definitely making a series of lower highs, lower lows. This is the type of play we see. We're going to look back a long time from now. And it's just like the marijuana sector ETFs and stocks. It goes up, has a blow off phase, and then it just goes like this. And it goes like this forever and ever and ever and just becomes worthless. So, I mean, I hate hype stuff like this. And
I
stocks are
think
a little bit different than trading Bitcoin because this is a stock, which means it doesn't actually have to trade at the value of Bitcoin like a Bitcoin ETF. When people get tired of this stock, they're going to dump it, even if Bitcoin is going up. And the stock will go down when Bitcoin goes up. So there is a problem, in my opinion, which is the whole reason why I'm like, if you want to trade Bitcoin, just trade Bitcoin. Don't hold a stock that holds it because that stock price can drop and completely diverge from the actual movement of Bitcoin when there's a max exodus in like
And this
something.
one's trading at a significant premium to Bitcoin. And I think one of the reasons why people like trading it is one, because of the volatility, two, because the founder of the company, Michael Saylor, he's very vocal. He talks about
Totally.
Bitcoin all the time. He's probably Bitcoin's biggest cheerleader.
For
So that
sure.
also adds to a lot of the volatility and
That's
price
probably why I
movement.
don't like it so much because I'm just not a Bitcoin cheerleader. Yeah, I mean, I'll trade it here and there occasionally, but yeah, I'm not a fan of somebody who just pushes a commodity or an asset just because they own it and they want it to go up. And I and it's just like it's one of those zapper lights for bugs. A fast moving stock just lures in people and they all usually get fried. And I hate people who endorse stuff like that. Like it's just not my style.
And
But
Chris, just because we're on the topic of Bitcoin, why don't you pull up the Bitcoin chart? Let's take a look at that one. It's had a bit of a pullback here. I think it's around 85,000.
yeah, I mean, Bitcoin's not looking the greatest. It definitely has broken through this support level. If I was to just draw a line here, you can see we clearly kind of put in a little bit of a double top. It's broken down. We had some huge volatility, which drives me nuts. Trump says something to try and hype up Bitcoin. Everybody tries to hype up Bitcoin. I don't know, it gets under my skin for some reason. But you can't trust these moves, these massive, that was like a 12, 13% move because Trump says, hey, we're doing Bitcoin reserve or something. And then everybody piles in and then they all take a big loss. People need to not mess around with news driven moves because they're painful. But overall, it is moving up into resistance. This is very similar to MicroStrategy, has a tiny little bull flag here. It's pretty ugly, but it could push and poke higher. And maybe come up to this 99 or 100,000 mark, which happens to be resistance from these highs. It also is a whole number. Typically, if you come up under a whole number, which is 100,000, people will just naturally say, I'm going to sell some if it hits 100,000. So those numbers alone become resistance. Not only that, but there's definitely a lot of price that has traded through there that anybody who bought at or above 100,000, when it gets back there, they're going to be like, I'm going to close out the position, get rid of that loss. That was a scary roller coaster ride. So, I am bullish a little bit here for the next week or two on the stock market, which should drag Bitcoin up and kind of, the rising tide should lift all boats, including Bitcoin.
Now, if we get a meaningful pullback here, Where do you see Bitcoin going? Can this thing go down to 60,000, 50,000?
Yeah, so if we were to look at this pattern here, this move to the downside and then this bounce, I'm not going to go from a news driven high. I generally avoid using price spikes that are from a news kind of driven event. So if we were to just gauge this, it brings us down to about 72,000, which obviously if we take a look at this chart, that's kind of where it broke out here before it took off to that 108, 109,000 mark. So that would be this whole move um, to the upside, kind of wiped out. This was a trade we did in Bitcoin. We got in, we got long right here. We sold right up at this top at 1087. And that was where the chart said momentum should stall out, which it has totally stalled out, and now it's going to probably come down and rewind. And the whole reason one of the main reasons we got into this is because it's a cheerleader, crowd-driven move. Once it breaks out of this pattern, and you and I talked about this, James, a long time ago, this giant bull flag pattern where the market ran up, had this huge bull flag. Once it starts to break this high through here, this is going to cause headline news, and everyone, including kids, trade Bitcoin, and we're going to see them all pile in and just drive it up. That was one of the reasons I'm like, let's just play this because it's a perfect chart pattern, and the FOMO is going to be out of this world. Now it was a 40% trade that only took a couple of weeks in, out, and it's over. And now you need to let the charts, regroup and hopefully create another really good chart pattern at some point. But right now it is pointing to lower prices, like over the next month or so.
So why don't we take a look at gold, something that's near and dear to my heart. And
Mhm.
gold's had a nice move here. I believe it's up 10% on the year. It's up 40% in the past year. Not Bitcoin like moves, but gold tends to be a lot more stable.
Yep. Yeah, I like gold. Gold's been obviously it's having its series of rallies and pauses. It's come all the way up to our key target of 2750, 2800. We ended up seeing a big pullback and big volume spikes as there was some unloading there. But now it's pushing higher, and just based on the momentum and the Fibonacci extension, we can kind of gauge where this high should go, which is right around that 3050. So we've come up to the 618. It's kind of building a little pattern here, a pullback. I believe we're going to see a push up to 3050, which, it isn't huge. We're looking at a 4 or 5% upside in gold.
You got to be
But
more bullish than that, Chris. Come on.
I mean, that's where this chart pattern is going. Okay, we can do another one. Uh, I don't. I do think gold is kind of starting to get tired and stall out. So I hate to always project something further up because if I put a big target on something, everybody jumps in and trades it. If I put a realistic target, 4%, nobody trades it.
No,
But
that's
I,
fine.
I
That's
feel
fine.
like gold's getting
I'm
tired.
just kidding. But just for our viewers, Rick Rule, many of our viewers will know who he is. I just did an interview with him earlier this week. He's very bullish on gold, and his target, I believe, he said 9,000 within the next 3 years. So once again, going from 3,000 up to 9,000, not a bad rate of return,
Yeah. So
and you can
there
sleep at
is.
night.
Yeah, I mean, I believe we'll be way up there. I don't in 3 years, it's possible in 3 years for sure. I do think we're going to get way up there. It might take a little bit longer than that, but I think he's right. I think, the big picture and the trend is higher. I think we might have some weakness this year, some pretty good weakness across the board in asset classes. But overall, I do believe we'll be up in that range that Rick's talking about. This most recent rally up and this quick pullback, if we were to just gauge based on this run, we can see where those next targets are for gold, which from where it is right now is about a 5% to 10% move, which brings us to roughly $3,200 to the upside. So there is potential that if this leg of gold has more behind it, it could muscle its way up. Uh, that's a potential for sure.
I want to take a look at oil, West Texas. It's been very volatile. Got as high as $77 here in the last few months. Now it's around $67. I don't know if this is a sign of a slowing economy, globally speaking, or what, but it's really pulled back here. And I know the last time we spoke, you were quite bearish on oil.
Yeah. So yeah, I believe we're going to see oil break down. I think for a bunch of different reasons. Technically, it keeps hitting the support level. It's getting more clear or getting weaker, depending on how you look at it. It's a more significant line. Once it does have a clear break, I think we're going to see oil drop dramatically, probably into the mid 50s at some point. So I think there's a big unwinding event. The technical chart doesn't look very strong. I also think, we've got the Gulf of United States where they can now just drill and pump. Um, so I think there's a lot of stuff going on that means lower oil pricing, and I think the economy is going to get weak, which means travel and product sales and oil's used in like so many products. All that stuff is going to decrease demand. So I think oil has been telling us this for a long time. I think things really peaked out in 2022. But I think the oil is telling us the story kind of what the economy is doing. The economy is still holding up, but it is on the verge, I think, of breaking down. And when energy breaks down, energy stocks are going to get hit really hard. And so I think it's interesting and important to follow oil. I think it's going to lead the economy, give us insight to, if it breaks down, that means the economy, I think, is getting much weaker.
Chris, why don't we take a look at uranium? I do a lot of work with uranium companies. A lot of my viewers have an interest in uranium. I think it's a great long-term trade, but
Yeah.
it's been under pressure here for quite a few months now. It topped out in 2024, and it's been weakening or under pressure ever since.
Mhm. Yeah, I mean, uranium stocks, this chart doesn't go back far enough, the Sprott one, but uranium stocks have built a mega base. I'm very excited about them. I think after we go through a financial reset, which I hope we get this year, I think uranium stocks will probably get beat up more. They are definitely fizzling down or selling off down to this breakout zone. They're getting to a pretty key support zone. So I'm expecting this particular, I think this is US currency for this one, but I'm expecting it to find support between 12 and 14, anywhere here. And if the stock market bounces, we should start to see this bounce up. But I'm the same as you. I think after we have a financial reset, we're going to come out of this next recession, and AI is going to take over these computer, the amount of power we need for all the AI stuff, because AI is really going to, I mean, we're really just scratching the surface here of what AI and the computing power and the energy needed to power all this stuff. I think uranium and the micro plants are going to be absolutely huge, and uranium companies are going to do very well. I think they could actually dramatically outperform um, precious metals miners in the next move. I think miners will do extremely well, but I think the next most valuable resources I think are actually going to be like water and electricity. And uranium is one heck of a way to generate clean electricity.
And why don't we take a look at the US dollar? The last time we spoke, you were bullish on the US dollar. You were putting a lot of your money into it. What are your
Mhm.
thoughts?
Yeah, so I like the US dollar. It's obviously had volatility. It's pulled back into the middle of this base, this range with Trump and all of his tariff wars and all this stuff that he's got going on. The long-term picture of the dollar, to me, is still very strong. I like to focus on it more or less on the monthly chart. Overall, it came down after the big tech bubble. It sold off. This is where gold took off for several years. It built a bottom and it's broken up, and it's just kind of, it's a very noisy chart. But overall, I think when we get into a recession, we get into difficult times, we're going to see this continue to have multiple waves to the upside and get back up to the highs that we saw back in 2000. More or less, if you're to like look at the forex chart of US dollar and Canadian, because you and I are Canadian, so I want to hold US dollars because Canadian dollar is, currently, about the exchange is about a buck 43, buck 44. So one US dollar is a dollar 44 Canadian. I believe that's going to skyrocket. I think we're going to see much higher pricing. So I want to hold US dollars, and I think the dollar index and the difference will continue to move up to like a buck 60, buck 70 exchange, which is a huge move. And of course, if oil falls, we tend to see the Canadian dollar fall in value. And I think oil is going to fall. And that means that's going to help fuel, Canadians to hold US dollar, I think is a good play here. And the dollar is right back down at a key support zone, right through the middle of all this. It's oversold. It's a lot of news driven move. So I do think it's it's actually kind of a prime time for the dollar index itself to probably find some support and start to bounce and continue to kind of work its way up and to the right.
I had a conversation with David Rosenberg a couple of weeks ago. We were also talking about the Canadian dollar. He would agree with your assessment. He actually said 160. So
Nice. Yeah.
that's going to
Yeah.
be a lot of pain for us. We will not be going to the US anytime soon.
For sure. Yeah, it's yeah, it makes it pretty expensive. It makes it really cheap for Americans to come over here though and have a good time.
Chris, why don't we take a look at one more chart before we wrap up? And that's the TLT. That's the 20-year bond. I want to get a sense of where you think bonds are going.
Sure. So I'm bullish. Well, I think we're going to see bonds do very well later. Now they were in a 40-year bull market with, falling rates forever. Now we had a rising environment which totally killed them. When you look at this chart here, it shows that we are clearly, we've been in a downtrend. It's now starting to put in a rounding bottom. And really these last couple lows and these highs here, we're starting to trade sideways. And this is considered a stage one. And eventually we'll see this start to rise and it'll go back up. I think that's going to start to happen this year. I think we're going to see bonds move higher above TLT above 100 and eventually go into a multi-year potential move, or at least have a really nice rally while the stock market potentially and the economy fall apart. That's I have this one chart that you and I have shared a few times here, just so people understand these stages I'm talking about. The stock market right now is in a stage three. Bonds have just gone down this from a stage three top all the way down to a stage four. And now it's in a stage of bottoming formation, a stage one. And it's shaded red and orange because it's a difficult time. You can waste a lot of time waiting for it to bottom. You can waste years. So stage ones are kind of dormant. You got to just have to let them play out, let them prove themselves that they're in a new uptrend, buy them at a higher price, but you also know they're going to continue to go higher. So that's where we're at with TLT. It's in a stage one right now. We need to see it get into a stage two, which is a bull market, and then it's going to become an opportunity. And it might be, for all we know, it could be one of the best plays in 2025 or 2026.
Warren Buffett had a discussion with a reporter on CBS, and he was asked about the U.S. economy, and he declined to answer that question.
Hmm.
But I think if you take a look at what he's done here in the past year, he's sold a lot of positions. He took his Apple position from 178 billion down to 70 billion. He sold huge stakes in both Bank of America and Citi and many other things. He's now sitting on, I think it's $335 billion in cash. So he's
Mhm.
taken a very defensive approach. He's now the single largest holder of treasuries. You mentioned a couple of times during our discussion, you're looking for a reset. What exactly do you mean by that? And are you as concerned as Warren Buffett is?
Yeah, for sure. I think a reset to me is more or less bubbles or overvalued commodities or assets finally top out, and there's everybody starts to sell. Things get weak. So it's kind of like a domino effect. I believe we're going to see um, sales start to slow, and then there's going to start to be more layoffs, which layoffs are starting to pick up. And then people like we're already seeing a big spike in delinquencies on credit cards. We've got, I think, the highest level yet of fully maxed out credit cards that people are gone delinquent. They're like, I will this time max out my credit card and then not pay it. And so that's not a good sign. And that's usually the first sign of like people running out of money is their credit cards maxed and they can't pay it. And then we're going to default into rents not being paid, which then mean those owners are like, well, I'm not getting rent because they're not paying and I can't pay for my mortgage. And then we start to see how mortgage defaults, which are already starting to rocket higher. And then people have to sell their houses, and we see the housing bubble and the prices, the market floods with homes, and home prices fall. Um, so it creates this whole domino effect. And to me, a reset is when all this stuff starts to happen, through that whole process, as the home prices are falling, people are losing their jobs, they're running out of money, businesses start to go bankrupt. I mean, back in 2008, I remember every day you'd hear about a new mega company going bankrupt, or filing for bankruptcy. There were thousands and thousands of them. And it's going to happen again. There'll be another wave of businesses going under and people losing their shirts. So a financial reset is really, it's a cleansing of the financial markets where everybody who's, all frothy and everything overpriced eventually becomes underpriced, and it creates a lot of pain. People take big losses. They have to sell things at discounts below value. And so I think one of those is coming. And that is, I mean, it's a huge opportunity. You can benefit from chaos, from falling prices dramatically, and it also allows you to reinvest if you can protect your capital at the start of a new bull market, where you can get real estate cheap. You can buy stocks that have great dividends, and you can buy them at a fair value, and businesses and all that stuff. So a reset is going to be severe. It's going to be like a 2008, like a 2000 tech bubble. Um, People are going to get hurt. This is like life-changing, life-threatening stress, financial stress that is applied to people and their businesses and their relationships. And that's the whole reason of what I do, what I do. And I share my asset investing strategy in my book is like, how many people can I help avoid this? We understand the stages. We can follow the trends. We know the strength of the market. You do not want to get caught on the wrong side of this. And there's more people 45 age and up who are close to retired or retired, that this is going to completely ruin their second half of their life, the best part of their life, because they're going to lose it, and the stress, money and the stress kicks in, and lifestyle downgrades, and everything you don't want is going to happen. And the market is great at applying the maximum pain to the largest group of people at the worst possible time.
And so, just to summarize what you said there, first of all, with regard to credit card delinquencies, it's at the highest since 2011. So, very significant number. Now, in terms of this reset, you said, okay, in the coming days, you think the market is going to stabilize. It's going to rally up to maybe 6,000 on the S&P, or a little bit higher. I believe you actually gave a specific date, March the 21st.
25th. I
Okay.
mean, that's just what cycles change, but yeah, that's just a
And
rough
then
that
we're
gives
going
you.
to start heading lower again. And
Yeah.
this is when you think we're going to have a significant pullback. When you talk about a financial reset, are we talking 30%, 40% on the S&P?
Yeah, I think it'd be somewhere between 30 and 50% on the SP 500. It could even be higher than that. It'll be very interesting to see how falls apart. But I think it's going to be pretty ugly when it does happen. I'm not saying the top is in the market. This bounce could turn into another little push higher. That's the joys of what I do, is we follow price, and eventually when it goes down and we're benefiting from falling prices, it just keeps falling and we can continue to benefit. It's not so much about trying to pinpoint the top or the bottom, but yeah, I think we're looking at it probably a 30 to 50% pullback in the SP 500. I think over the next 12 months. I think it's going to happen sooner than later. All the signs seem to be there, and the price action seems to be. The Magnificent Seven topping out, to me, is a huge red flag. If that goes down and people start unloading those, which the masses have them, and the masses are very emotional, which means when they start selling, they all start selling. And when those seven stocks crash, so do the indexes, and everything else will go down with it.
And you're suggesting to investors in such a scenario, they got to be long cash, US dollars specifically, and also long gold. Anything else?
Yeah. Yeah, I think gold will get hit. I don't think gold's going to hold up as well when the selling hits, but I think bonds could become a play. There will be a point where we focus on trading inverse ETFs. So if the stock market falls 5%, we have an ETF that goes up 5%. So at some point, once we have a definitive financial reset in place, a stage 4 decline, then we focus on falling pricing, because on average, every week and month, the price is going down. So we want to bet with the market, which means we're betting on it falling, and there's a way we can profit from that. And so there, you do need to change gears and actually like ride benefit from falling pricing, and it's pretty straightforward with inverse ETFs now.
Yeah, and I'm not sure if you saw the comments out of Scott Bessent today, the Secretary of the Treasury. He also commented that he thinks the U.S. economy is slowing down. He thinks there's going to be a bit of a transition as we go from government spending, or excessive government spending, to more private spending. So it's going to
Yeah.
be interesting to watch these economic numbers as they come out in the coming weeks and months. Even the unemployment number that we saw today came in a little bit higher at 4.1%, up from 4% in the last month. But if we see an uptick in that here in the coming months, so it's
Yeah.
look out, all bets
Yeah.
are off. So that was a great discussion, Chris, and I want to thank you for joining us on such short notice. It's been so much news going on this week and last
Mhm.
week, so thank you for that. If somebody would like to learn more about you and your services, where can they go?
Yeah, you can check me out on YouTube, The Technical Traders, or you can go to my website at thetechnicaltraders.com and join my free newsletter, watch some of my free videos on YouTube, get a feel for what I do, see how I view things, how I track price. very educational videos on if you like technical analysis. And yeah, that's the best way to follow me.
And you're also on Twitter.
I am. Yeah. Yeah.
What's your handle?
I don't know. I don't do Twitter. I
All
don't
right.
post on,
I'll have a
I
link
just
below in the
focus on
show notes.
YouTube. And
Chris, once again, thank you.
always a pleasure. See you, James.